Good afternoon, folks. Welcome to another edition of Weekly Wrap. So, being a holiday, I'm bringing the Weekly Wrap to you from home this time. And I only hope I'm as comfortable speaking from home as I do from my office. Right? We tend to get into these grooves, right? We get habituated to doing things from one place. And any change brings us great discomfort. And this, I think, is something we all should learn to get out of this rut. Because as we get more and more stuck in these ruts, our brain is not going to be growing. Fresh neural connections are not going to be happening. And believe you me, if we're going to live longer, we need to keep our brain active if we want to go have a good, healthy life. So keep exploring, keep learning new things, keep doing new things, and that keeps the neural connections going on. And that's the best way to avoid dementia in your old age, right? So let's keep that in mind. Coming back to markets, last week markets were largely flat. We had some yo-yoing in between, and daily markets were largely still correlated with whatever the US president said or in his press briefings. And while some of the FOMO trades in India didn't work out, the FOMO trades in the US continue to hold good, with the S&P 500 up almost 2.8%, the Nifty 50 being up about 0.5% roughly, so largely flat. Outflows continue from the Indian market, but friends, be assured that it is not just India that is experiencing outflows. All emerging markets are experiencing outflows. The EMX China has experienced about $68 billion of outflows in the month of March, out of which India accounts for about $12 billion of outflows. Korea, Taiwan have all been experiencing significant outflows. Most of the money is going back to the US. And we actually saw an appreciation of the dollar index in the interim. Strangely, when there's more signs of conflict, the dollar strengthens, and the moment the signs of conflict comes our way, the dollar index falls a little bit. Some of the things that are happening completely uncorrelated and very strange, and each market seems to be telling us a different story. So if equities are up, it seems to be saying that they are confident that the war will end soon. Okay, bond yields have been falling in the US after hitting a high, and they've been coming off, and again that seems to be showing optimism. But the crude oil prices are not coming off. Crude oil prices remain firm, and at times very volatile, going up, and that seems to be saying a completely different story, that oil shipments from the Straits of Hormuz are not going to come out quickly. So maybe they are more short term in their nature, whereas equity markets, bond markets tend to be longer. But I still urge you to be aware that different markets tell different stories, and one has to discriminate and apply your powers of discrimination to see what each one is saying and pick what you think is most right and relevant. Okay, and while Indian markets have been falling, also know that price earning multiples are falling because of this. Okay, and now we are into a 19 times PE territory, which is pretty good, I think. Okay, we've come off a high. We had almost touched 26 times price earning multiple at its peak. Then we were at 23 for a long time, and now we come to 19. And so I think this is a reasonably good time for anybody to begin to accumulate fresh positions in equity. All I say is remain diversified, don't take too much risk, but you can begin your allocations, fresh allocations to equity with this kind of markets. You may not see an immediate result, but over time, you are going to see the benefit of buying at lower PEs. Okay, retail inflation is inching higher. We reached 3.21% as on Feb end. And mind you, this 3.21% is not on a low base, but it's on a high base of last Feb. Okay, so, and inflation, I think, is only going to get a little worse as we go by, as the impact of higher energy prices trickles down into all levels of the economy. Not only in India, the rest of the world is also experiencing this. and thankfully we are not experiencing as much shortages as some of the other smaller countries are. Okay, at least in Bangalore, all we are sacrificing, it seems, as masala dosa, because the Darshanis have stopped making masala dosas due lack of gas. Everything else seems to be going on fine. 10-year GSEC, reflecting all this worry, has crossed 7%. I think it's signs of tighter monetary policy. Let us see what the RBI says and does. But one thing that has been doing well is controlling the depreciation of the INR because of its actions over the last few days on clamping down on open positions being held by banks. The rupee has recovered some of its lost ground, and I think that's good. Without spending billions of dollars, just by these actions, it has been able to control the rupee's depreciation, which I think is great. Okay, and going in, let's see what interesting articles. I didn't see too many, but while we are on the rupee depreciation story, there's an article here says the rupee's depreciation is neither unusual nor indicative of great stress. So here the author Prasanna Tantri says that there's not too much to worry about, because why? Let's see what he says. Okay, so what he wants us to look at is the real effective exchange rate and not the nominal rate. When we see the rupee going from 90 to 94, that's the nominal rate. Okay, but what is actually the purchasing power? So he says, consider a simple example. Suppose an item X costs rupees 50 in India and $1 in the US, with an exchange rate of 100 rupees to a dollar. The real exchange rate is then 0.5, meaning an Indian item X is half as expensive as an American item X when expressed in a common currency. So the same item when bought in India is 50 rupees. It should be costing half a dollar in the US also, right, at 100 rupees. But it actually costs it costs a whole dollar in the US, which means that the real effective exchange rupee rate is 0.5. Now, if you were to go into this deeper and track this, suppose the item in India became more expensive from 50 to 55, and at the same time the rupee also depreciated from 100 to 110. Okay, so one would get unnerved saying the rupee depreciated from 100 to 110, but the ratio of what you're buying in India and what the same items cost in the US remains at 0.5. So if the dollar is costing 110 rupees, and the item in India costs 55 rupees, it still is 0.5, a dollar to the same item. So we need to be tracking the real effective exchange rate. And what the author is saying is, actually, in the last 6 years, on this basis, the rupee has appreciated 8%, not depreciated. And this is a sharp move. And what we are seeing now is only an unwinding of that sharp appreciation and not a real depreciation. So let's keep that in mind when we're looking at it, that we need to look at the real effective exchange rate and then decide whether the currency is depreciating or appreciating unusually. Okay. So he also says that we need to be worried about the volatility and controlling the volatility rather than the actual nominal rate. So, and the RBI is doing its best to try and control this volatility with its action, and it's pretty working out so far. Okay. And then another significant article, I thought significant because we have a lot of people coming back to India, non-resident Indians. And this article's headline reads, from UAE to India, how a temporary return can change your tax status. One may think that just coming back from the UAE and staying for a few days here, nothing changes, but no, please be aware, it could change your residency status. Okay, so if you are resident in the UAE and you don't pay taxes there, and on your Indian incomes you're filing a separate return and you pay taxes on Indian income, you don't have to declare your UAE income, or you don't have to pay taxes on your UAE income in India. Okay, but if you have by chance stayed less than 183 days in the UAE and stayed more days in India, then you become a resident but not ordinarily a resident of India, in which case you lose some of those tax benefits. You will have to declare and pay tax on your UAE income in India. So do be aware that changing your residence status can impact your taxation. So be very careful. You don't want to be caught on the wrong foot and be paying huge penalties and fines to the government. Okay. And actually, one of the most interesting articles I came across was in the Monday's Mint, and this is an interview with Lloyd Blankfein. The headline says Lloyd Blankfein on life, luck, and regrets. Who's Lloyd Blankfein? He's the former Goldman Sachs boss, and he's written a book called Streetwise: Getting to and Through Goldman Sachs. Okay, so the couple of interesting questions that were asked by the interviewer here, I will read out. It says, one of the questions goes like this: you have seen a lot of bubbles up close. Do you think the present frenzy around artificial intelligence is a bubble as well? And he says, when we have the 10th reunion of this video call, we'll look back and I'll tell you whether it was a bubble or not. It doesn't matter what I think, because in a bubble, everybody is thinking wrong. So right now, I too am caught up in the same enthusiasm that a lot of people are, which is that AI will have a profound effect on organizations, on how we do things today, and it will also allow us to do things that we never contemplated doing. But is every dollar that's being spent on AI going to have a return in the future? Not so much. So there's your punchline. Okay. So yes, AI is impacting our lives. It will continue to impact our lives. We'll be able to do a lot more things that we were able to do in the past, and we're all aware of it. But coming down to the commercials, the huge investments that are taking place in AI, the numbers that we read about, $600 billion, $800 billion of investment taking place in AI infrastructure, is it going to yield a satisfactory return? He thinks maybe not. Okay. And if they don't, then a number of these stocks, AI related stocks, are pretty overvalued. And that is what we need to be careful of. Another question. So you write that few people are able to be objective and rational about risk. How should a common investor think about risk? Wonderful question, I think, to somebody who's been the boss of Goldman Sachs. And I love the answer. This is how it goes. As we are having this conversation, there's a war in the Persian Gulf. Would you have given that a high chance of happening even 2 months ago? Would you have 5 years ago thought that we would be having this conversation about artificial intelligence? Things come at you from odd places. Risk management is making sure that contingencies that can reasonably occur are accounted for. So for the common person who's investing, I would say, don't do leverage. Only invest what you can reasonably afford to lose, and don't over-respond to short-term phenomena that occur because you read about it in the newspaper. Also, don't get overly seduced by good investment opportunities because you just don't know how things are going to work out. So relevant to the kind of crisis we are going through. We don't know how things are going to work out, and one should not overly jump into any kind of an investment idea. But the thing about risk, I think it's amazing what he has said in such simple language. Even Taleb used to call these outliers black swans, right? That's why he coined the word black swan. And these are things essentially that we don't know. These are events we don't know will happen. These are events we don't know when they will happen. We have no idea. They come at you out of the blue, and it's only after the crisis happens that you realize that, wow, we are in a crisis and we never thought about this. We never planned for this because we never knew it would happen. Okay. So how does one deal with such a situation then? I think the best way to solve for such a situation, if you are in a risk-bearing investment, have enough time to allow the investment to regain its market value. This will of course happen only if you're in a good quality investment, not a bad quality investment, mind you. A bad quality investment falls and stays down. A good quality investment falls and recovers its value. So even the 2008 global financial crisis, after such a bad crisis, it took about 18 months for market values to recover. So if you have the time on your hand, you don't have to panic and maybe even use unnatural falls to accumulate more equity. Okay, so do think of it at these lower PE levels, not hugely cheap, but cheaper than where we are, and possibly a good time to invest. But spread your investments through time and ensure you're not taking the wrong call. You will have to speak to an advisor before you take such calls, because it's dangerous to do things by yourself, is what I think. Better go to an expert. Okay, that's all for this week, folks. Have a great weekend.